start with some of these comments from Gulliver. We've crushed our reputation with the Mexico events. Not fit for purpose 2 years ago. Hugely surprising, these comments.
Yes, they are. One does wonder, with the amount of announcements that have been made over the last couple of months for all the banks and various regulatory breaches, whether there is now at last an element of kitchen sinking. I mean, to put this into perspective, a lot of the scandals and mistakes that we've seen, be that LIBOR, PPI, interest rate swaps, or indeed Mexico, do tend to be ones that are sort of 3-4 years ago at the very minimum. And I think that the bank boards have finally realised that we need to, A, pay what we need to pay in terms of censures for making mistakes, but B, and equally importantly, explaining to the regulator and indeed investors that things are now totally different and that a new brush has been brought in.
Some of our guys at Breaking Views argue the banks are getting off too lightly. What do you think?
Well, if you take the amount of fines that they've had to provision for in the round over the last year or so, that's a moot point. I mean, the fact of the matter is, of course, they're in this strange situation where they, in regulatory terms, they're being asked to put more money aside to improve their core Tier 1 ratios, let alone any expense involved with more regulatory requirements, set against which, of course, they're being encouraged to lend. So it's a difficult position for the banks to be in operationally, let alone the fact that they've got a number of legacy issues which really do need to be dealt with once and for all.
Let's talk investing in these banks. The index is down about 0.6 today. RBS and HSBC are both up. RBS has outperformed over the past 3 months. I think we're up about 18-19% year on year. What do you make of these as investments right now?
Well, I think the first thing you have to realise, of course, is that they're not the safe, immediate automatic entries into a portfolio which they were 5 or 6 years ago. I think you also need to feed into the mix that we're in a historically low interest rate environment, so you're probably going to be looking for banks which pay some sort of dividend, which of course immediately rules out RBS and Lloyds, let alone their government stakes. So then you're looking at something which has probably come through without government interference, perhaps Barclays, for example, with its universal banking model, although we'll hear more about that next week in its full year results. But generally speaking, in terms of the market consensus, with its 3.5% dividend yield and general strength and global stability, the favoured stock of the sector remains HSBC.